From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, the diplomatic efforts accelerate. The Fed not holding back on rate hikes, pushing the yield curve to slowly invert. We begin with the big issue. Big plans meet skeptical minds.
The numbers don't add up.
We finally got the first Fed rate hike of this cycle.
We have the dot plots that show about 7 rate hikes.
7 hikes for this year.
2.8% by the end of next year. That just doesn't seem right.
I can't add these numbers up and make any sense of them.
It's unrealistically hawkish.
I think that's mission accomplished.
Mission accomplished.
It's fanciful to think that we don't see an increase in the unemployment rate.
The Fed's not in a position to predict or forecast a higher unemployment rate.
Do you really think that a tightening cycle is not going to have any effect on the real economy?
Their growth forecast for this year.
I don't really see this playing out the way that it was laid out.
This is all fantasy land.
What's fantasy land is that people think that inflation is going to come all the way back down to earth.
I still think there's confusion.
Breaking news, follow the money. Here's our reporting. Some Russian bondholders say they got coupon payment in dollars. Some holders of that Russian debt say they got those coupon payments in dollars. We followed the money from the state, through the clearinghouses, through the banks, ultimately ending up in the hands of investors. Some Russia bondholders say they got coupon payment in dollars. That headline just crossing. Perfect timing. The guests join us right now. JPMorgan's Kelsey, Berro, Nuveen's Tony Rodriguez, and Morgan Stanley's Eric Stein. Kelsey, the Fed had to put together some forecasts. Tell us what they're going to do with rates this year and next year. And we're dancing around week to week trying to work out whether a big sovereign's going to default or not. Is it likely the Fed can do what they said they'd do this week?
I think it is likely. I think that they are on a course to hike rates 7 times at least this year, and there's a potential for them to do 50 in the May or the June meeting. Chair Powell, he said it best. He said, we want to get rates back to neutral as quickly as practically possible. And that's what they're going to do, which means that they need to get to at least 2% on the Fed funds rate, and they can do that by the end of the year. And if you look at the dot plot, the full of the committee agrees. There isn't a dot in 2023 or 2024 that's below 2%.
Let's look at that dot plot. You can look at the front end for 2022. There's one dot sub 150. There's one dot north of 3%. We know who that is. The St. Louis Fed President Jim Bullard said this earlier today. I recommended that the committee try to achieve a level of the policy rate above 3% this year. This would quickly adjust the policy rate to a more appropriate level for the current circumstances. Tony, is this achievable? Can they get Fed funds north of 3% this year?
Hi, Jonathan. Good to be with you. No, I really don't think there's any opportunity for them to get it to 3% this year. If you look back a month ago, the market was pricing in 50, and the Fed did everything they could to talk the market back down to 25. So when they had an opening, they chose not to take advantage of it. So we see this as a Fed that is clearly focused in terms of their reaction function now solely on inflation, but they also are very, very interested in making a gradual, methodical, well-communicated approach. So we're thinking 25 basis points a meeting. Would we do 50 if it was up to us? Yes, we think that getting there a little faster, the market can handle it. You look at the 2-year, the 5-year, they've all priced in the tightenings. So the opening is there, but we think the Fed will be more gradual.
Eric Stein, your take.
Yeah, look, I think the Fed is very much still intellectually dovish, but cyclically hawkish. They are certainly in the mode to raise rates right now. 3% seems very aggressive. I don't think the markets would take that, but I very much agree with the first two guests. They are on a path to continue raising rates. It would take something really big for them not to continue with that. But keep in mind, at some point in this rate hiking cycle, if the economy slows a lot, maybe they change course. So right now, they are hiking full steam ahead, but I still think there's a lot of intellectual usual doves on the committee that are just cyclically hawkish because of where inflation is right now, what that means both for the economy, but also politically. Inflation is a hot button issue, and certainly that's got notice at the Fed.
If you're just tuning in, a bit of breaking news in the last 5 minutes or so. We've been following the money from the sovereign, Russia, all the way through the pipes to the end investor. We're reporting now here at Bloomberg, some Russia bond holders say they've received the coupon payment in dollars from the Russian state. There was about $117 million worth of interest payments on $2 bonds earlier this week on Wednesday. We understand, according to some Russia bond holders, they've received that money. The range of outcomes this year, Kelsey, with all of this in mind, just incredibly wide. There is a group of people who believe the economy is strong enough to take this, strong enough to see higher interest rates, strong enough for the economy to flourish, even in the face of that. Chairman Powell said exactly that. Then you have the doubters, Kelsey, that believe one hike, two hikes, 3, 4 hikes in, you get an inverted yield curve, they have to back away. Why are you not in that latter camp?
Right. So we do expect the economy to remain strong enough to withstand these hikes. I would highlight we're coming into the spring and the summer. There may be another burst of reopening as we've now made it through another wave of COVID. We also are looking at the consumer. They're extremely strong. They have high levels of savings. They are still comfortable with costs rising because wages are also rising. And on the corporate side, we look at how corporates are positioned, corporate America versus pre-COVID, and they have more cash on hand now than they did pre-COVID. They have less leverage now than they did pre-COVID. So one of the areas where we've seen value created over the last 2 months with all this repricing is investment grade credit. It's underperformed versus other cross asset like high yield. And the fundamentals there are still strong. And you can start to see all-in yields are much more attractive now than they were a few months ago. We're looking at over 6% on high yield in the US and over 3.5% on investment grade yields.
Kelsey, is that a bet on a soft landing?
Well, in the near term, yes. I think that there is just a lot of momentum in the U.S. economy, and the Fed is determined to continue to go. But that doesn't mean that the yield curve isn't going to flatten, because we actually do expect the yield curve to continue to flatten. And I think we actually have to expand our minds and envision a yield curve that actually could become severely negative as we move into the second half of this year. And the yield curve, we're all fixed income investors here. You cannot ignore the yield curve. It is telling you that growth is going to slow as a result of the Fed tightening. But the reason that we're doing this is because the economy is running very hot. Demand is far exceeding supply. And this is what they need to do to start to bring that back into equilibrium.
Tony, let's go through the yield curve. 3-year yield right now, 215. 5-year yield, 215. 7-year, 218. 10-year, about 215. We're already inverting here, Tony. We're one hike in. You've got Governor Waller out on CNBC this morning talking up 50 basis points. Then there was Fed President Jim Bullard talking up 50 basis points. Tony, isn't this the direction of travel now over the next couple of months? Is it inevitable we just invert this yield curve, just a few hikes in to this rate hiking cycle?
Well, we would think that it's pretty likely that you'll have a modest inversion. As I said earlier, I think what you're seeing in 2s, 3s, 5s, et cetera, is that they've already priced in the hikes. So the Fed is way behind still in terms of a 50 basis point hike today would have been acceptable to the market. It's already priced in. Having said that, we definitely think we're going to continue to see flattening, potential inversion in the curve. The Fed's going to be very concerned about inverting the front end, meaning the funds rate, the 3-month bill rate, versus the 10-year. As that starts to come into play later this year, that's when I think you're going to have to recalibrate to whether or not the soft landing is achievable. We think there's some possibility of that, but clearly the historical record is not very positive about that. Or you're going to see a more significant slowdown that causes the Fed to have to be more aggressive, and that's when you have your 2023 recession outlook come into play.
Eric, that yield curve right now, those numbers on that screen, are they reason enough for this Fed to back away? If they get worse than it already looks, if the kinks start to kick in even more, we start to see a more pronounced inversion, is that a reason to constrain this Fed and its ability to deliver more rate hikes?
Yes, I don't know if it constrains the Fed from hiking. As I said before, I think they're going to continue doing it. It may constrain them from doing 50 basis points. It may push them more to use balance sheet as a way to reduce monetary policy accommodation as opposed to going 50 basis point on a rate increase. But I think it's a really interesting point looking at the shape of the yield curve, because lots of talk that, the Fed has lost credibility. Look at where inflation is today. But if you look at the U.S. yield curve, as flat as it is, as flat as a pancake, you just said 3 years out to 10 years, and the 30 years only 25, 30 basis points higher than the 10-year. That shows me that the Treasury market is not particularly concerned about inflation. I certainly agree with what others have said. The shape of the yield curve matters. So I don't think it stops the Fed from raising rates, but it maybe makes it harder to go 50. And I also think it brings into play the Fed's balance sheet. Maybe they're a little more aggressive on balance sheet reduction, a little less aggressive on the rate hike path.
We'll pick up on the balance sheet story in the next segment and talk about risk assets more broadly. I was surprised more people in the news conference didn't ask him about it, seemingly how willing he was to deliver the response to those questions. Kelsey, Berro, Tony Rodriguez, Eric Stein sticking with us. Coming up on the programme, up next, the auction block. Fed liftoff fueling the big banks to come to market. That conversation up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe. Issuance exceeding expectations and topping 28 billion euros. Financials doing the heavy lifting with JPMorgan, Deutsche and Credit Suisse pricing the bulk of supply. In the US, high-grade bond sales gaining momentum after the Fed's rate hike. Bank of America and Wells Fargo leading a wave of deals boosting supply for the week to 29 billion. And the junk bond market stalling out for the second straight week this month. Borrowers staying on the sidelines, posting the slowest first quarter since 2016. Some breaking news in the last 20 minutes just to get you up to speed. The team here at Bloomberg reporting the following, that some Russia bondholders say they got coupon payments in dollars. We're reporting the following. Bondholders say they were notified of the credit on their accounts on Friday. The $117 million interest payment on $2 bonds, of course, were due on Wednesday. So hopefully that clears some of that up for now. Of course, we're going to be dealing with this again and again and again over the next few weeks and months. Still with us, Kelsey, Berro, Tony Rodriguez and Eric Stein. Kelsey, have we fully realised the risks associated with this story yet? And if you were to draw that conclusion, what data points would you identify to do that?
There is still a lot of uncertainty. Some of the uncertainty is, related directly to the epicenter of what's going on. So as you mentioned, there will be more Russia debt payments that need to be made over the next few months. And this is not going to be the first time that we're discussing it. I look at the market, I look at the cash Russian government sovereign bonds, what they're pricing versus the CDS. I see there's a large basis there, which means that there is still a lot of uncertainty about settlement. This story is absolutely not over. But when I look more broadly at the rates market, I think that what's being priced in is fairly rational. I look at yields, they're higher. That's because the Fed has told us they're going to look through this. They're going to focus on inflation, which is still high. But rate volatility is elevated, and that makes sense in a situation and an environment where there is certainly a lot of uncertainty.
Tony, do you think the market is starting to look through this? I look at the incoming information, and then from my position, the cheap seats, I look at how the market responds to that incoming information. And it feels like over time, over the last week specifically, feels like, Tony, that market participants have become somewhat desensitized to the incoming information, the incoming headlines. Is there any signal there at all?
Yeah, John, you make a good point. I mean, we've seen the VIX fall. We've seen a little bit of a recovery in credit spreads. We've seen the equity market clearly had an incredibly great 3-day strength yesterday. So I think market participants are starting to come to grips with the fact that these situations that we're dealing with, high inflation, tightening Fed, Ukraine, Russia crisis, they're not going to go away overnight. They're going to be with us for the balance of the year. So having to position yourself for that is what I think investors are coming to grips with. The initial reaction was very risk-off, very access liquidity quickly. Now I think people are settling in to try to say, where have I seen maybe value created given some of the moves we've seen? And how do I want to be positioned for a market environment that's going to remain uncertain and tricky through the balance of the year from our perspective?
Eric Stein, your take.
Yeah, look, I think it's a good point you make, Jonathan, that, market participants maybe this week, as we're, 22 days or so into this, are a little more desensitized than they certainly were when it happened, a little over 3 weeks ago or so. I really think there's three things that have been driving markets over the past couple of weeks. Obviously, what's going on in Russia, Ukraine, the Fed, as we've talked about a lot, and China as well. If you go back, last week, it was all talk of delisting of ADRs, and this week, Liu He came out with, maybe more bullish or pro-market comments, and you saw Chinese markets go up a lot, which I think helped broader risk sentiment. So I think maybe market participants are getting slightly desensitized, even though it's an incredibly uncertain and obviously, tragic humanitarian situation. And then the Fed meeting, while the Fed was hawkish, wasn't so hawkish that the bond market, particularly at the back end, didn't sell off. It actually rallied by the end. And then the news on China, which has generally been negative, was actually a little bit more positive this week.
Dare I say complacent, Kelsey, Berro? When I look at the long end, if you get a rally on the long bond, the 30 years down another 4 basis points today, and the 2 years selling off, that doesn't sound like the kind of world that I'm hopeful about, with a 2-year yield rising and a 30-year yield falling. And that's what we've got today again. The interesting thing about this week for me is that they talked about balance sheet, and no one's really responding to balance sheet. And Kelsey, it reminded me of December. We had the news conference. Everyone ignored what Chairman Powell had to say. The minutes came out, which basically repeated what Chairman Powell said back in the middle of December, and everyone woke up to what was about to happen. Could we repeat that this time around? The chairman pointing to the Fed minutes for the QT balance sheet runoff conversation.
So I think that could happen again. And the reason being not that Chair Powell is going to say the exact same thing that the minutes are going to say, but the minutes may actually give us more detail on the actual pace of the balance sheet rundown. So Chair Powell has been very quiet on that. He's indicated that it's going to start very soon. We think it will start in May, but what they really haven't socialized is the sizes. So we're anticipating around 50 billion per month in Treasury rundown and 30 billion per month in agency MBS rundown, which gets you to an annualized pace of rundown of about $1 trillion a year. So what we need to see is, what does the Fed think about that? What is their pace that they think is appropriate? And I think that may be revealed at the minutes. And if that is materially different from what the market is currently pricing, you could see a surprise.
$1 trillion of QT. Tony, how do you factor that into your outlook for the market? How do you even begin to do that?
Well, Jonathan, I think you have to factor in, one, the reduced liquidity. So risk premiums have risen quite a bit. They need to be higher than where they were to factor in a tightening Fed, the liquidity reduction from the balance sheet. I think the other thing is that right now, the uncertainty from what the caps are going to be, how are they viewing it as, is 500 billion rundown this year equivalent to one tightening? So that basically reduces some risk that they become more aggressive. I think that'll be interesting as to how they're calibrating the tightening that occurs from the balance sheet. But overall, that means tighter financial conditions, lower liquidity. So you clearly have to have a view for kind of, in our opinion, risk premiums have cheapened. They're much more attractive, but we're not expecting a recovery back to levels we were. We think you could see still some modest widening from here as the actual implementation of that balance sheet runoff takes place.
Eric, give me the pitch, the sell. Tell me why I'd want to invest in risk assets in a world where the long bond's rallying, the 2 years selling off, they're going to raise interest rates, they're inverting the yield curve, QT of $1 trillion a year. We're cutting growth forecasts, not kicking them higher. We're raising inflation forecasts, not cutting them. Why do I want to put money into risk assets, into high yield, credit, corporate credit, America, EM? Have we corrected enough to even think about doing that yet?
So, I think we've corrected a little bit. Who knows if we've gone enough? If you want me to play bull and take the bull side, I would say, the Fed's going to raise rates, but likely we're still going to be in a negative real yield environment. U.S. economy is quite strong. Global economy, obviously dealing with the geopolitical shocks and oil prices, although they've come down a lot over the past week and a half or so, but still kind of recovering from various waves of COVID, depending where you are on the map. So I still think we're in an environment where on an absolute basis, risk assets could be attractive relative to a year ago when the Fed was trying to keep financial conditions as easy as possible. For sure, not as attractive as then. To me, the real open question is the Fed wants to tighten financial conditions. That's clear. How much pain can the Fed take if markets start to sell off? I think it's more than before, but I don't think it's unlimited.
Kelsey, final word.
I agree with the real yield being negative, continuing to be negative. We have just started this move away from accommodative policy. We still have a lot longer to go. This is more about relative value. For instance, it's not always about where we're going to buy. We've seen a repricing in European credit, for instance. It's underperformed U.S. credit. And this is an area where we're still going to probably stay away from, because with the new information we have, the ECB still planning to step away to focus on their price level stability target. This is an area where valuations have become more attractive, but that doesn't necessarily mean it's time to step in.
Kelsey, Berro sticking with us with Tony Rodriguez and Eric Stein. Coming up on the program, still ahead, the final spread, the week ahead, featuring a host of Fed speak and President Biden heading to Europe. That's next. This is Bloomberg. Time now for the final spread, the week ahead. Coming up through next week, a host of Fed speak, kicking off with Chairman Powell and Bostic on Monday. Williams, Daly, Mester all on deck Tuesday. Plus, we'll hear from ECB President Lagarde, Bank of England Governor Andrew Bailey. They speak through the week. The President heading to Europe, and you get some data to close things out on Friday. Let's squeeze in the rapid fire round with our guests and get straight to this first question. Pick a number. How many hikes this year? Pick a number. Kelsey, Berro.
At least 7.
Eric.
7.
Tony.
7.
Where does the Fed funds peak? Pick a number. The peak in the Fed funds rate. Tony.
2.5.
Eric.
2.25.
Kelsey.
275.
Year-end 23. The Federal Reserve has unemployment at 3.5%. Year-end 23, higher or lower? Unemployment higher or lower year-end 23, Kelsey?
Lower.
Interesting. Tony?
Higher.
Eric?
Higher.
To the three of you, thank you. Kelsey Berro, Tony Rodriguez, Eric Stein from New York City. That does it for us. This was Bloomberg Real Yield. This is Bloomberg TV.